Now that we went over our first lesson about power of 3, let's move on to the second lesson, which is about failure swings, low resistance liquidity. Now, first of all, what is a failure swing? A failure swing is a swing high that fails to take out another swing high, or a swing low that fails to take out another swing low. So this is low resistance liquidity, and we want to see this form on the opposing side of our structure. So for instance, when we are bullish, we want to see a bearish failure swing. A bearish failure swing is a high that fails to take out a previous high. And when we are bearish, we want to see a bullish failure swing, and a bullish failure swing is a low that fails to take out a previous low. And the market will usually go through opposing failure swings with ease, like a hot knife cutting through butter. Now we covered low resistance liquidity. Let's talk about high resistance liquidity, and we want to see this form on the side of our structure. So a low that ran a previous low and rejected is a high resistance low, and a high that ran a previous high and then rejects is a high resistance high. And we'll use this logic on all time frames. So over here we got a crude depiction of a market maker buy model. We've got our draw on liquidity up here, our structure, and our discount array. Now think about where we want to see those failure swings form, right? When we are bullish, we want to see those bearish failure swings, which is a high that fails to take out another high, right? So how does that look like? Over here we've got multiple failure swings, right? We have a high over here, which this high fails to take out. Then over here we've got this little trend line going on, which is a set of failure swings, right? So this high fails to take out this high, and this high over here fails to take out this high. And down here we've got even more, right? So high, lower high, and even a lower high. So all failure swings around here. Now once we hit that discount array and we've got a low formed over here, we want to be targeting those failure swings as our draw on liquidity. And why is that our draw on liquidity? This is low resistance liquidity, right? So we always want to go for that low resistance liquidity. Now, what do we want to see form on our side of the structure is that high resistance liquidity, right? So we know it's rejecting that low and we want to go bullish, so we don't want to see those lows ran again. But how does that look like? So over here we got that high resistance low, right? Because we run that previous low and then reject immediately. So this is a good confirmation that we are heading into bullish order flow. I always say high resistance liquidity runs happen on the opposing side of our order flow. So once we are bullish, every low that gets ran and rejected is probably a high resistance liquidity run. And the market will struggle to go below those lows when we are bullish. Now once we are bullish again from the discount array, we want to target those failure swings, right? That low resistance liquidity. And once we're in discount, we want to draw into premium, right? So once these failure swings are in discount still, that's even better because we want to draw into premium. And if we have that low resistance liquidity in our discount range already, then it's even better to draw into premium and take out that low resistance liquidity. So over here we got the inverse, right? This is a market maker sell model. So we've got our premium array up here and our draw on liquidity again down here. Now, what do we want to focus on, right? We want to focus on that low resistance liquidity. And where is that forming? Again, those failure swings, right? Those low that fails to take out another low. And we've got those over here. We've got again a little trend line down here, right? Multiple lows which fail to take out the previous low, even down here at our draw on liquidity and over here. Now once we hit that higher time frame premium array, right, we want to see that smart money reversal happen, so that change in order flow, but we want to see a high resistance liquidity run first, so we know that's on our side of the structure and confirms our order flow. So how does that look like, right? We have this high which gets ran and then rejects immediately, and if that happens, we have again a good confirmation we're going to go in bearish order flow. Now we can see all these lows, these failure swings, right, and they are all still in premium, which makes it even better if we want to draw at least into discount and eventually the target down lower. Now over here we've got another high resistance liquidity run and then rejects immediately, right? So again, on our side of the structure, we want to see those high resistance liquidity runs happen. So we know these highs are probably going to stay intact and we're going to continue down in our draw on liquidity, right? Those failure swings which we have down here, which are still in premium over here. And then we draw back down into discount levels, taking all those low resistance liquidity lows down here and also down here eventually until we reach that draw on liquidity. So over here we've got a E-mini S&P 500 futures chart. Now let's look where is the discount and where is the premium levels. We've got this low down here for our discount. We've got this high up here for our premium levels, right? And now think about that low resistance again, right? Where are the failure swings forming? We've got those failure swings down here, right? So this is low resistance liquidity, and this is a nice target where we can draw into. So notice how these failure swings are in premium, right? And once we go from premium into discount and those failure swings are still in premium, we've got that engineered liquidity down here, right? Those failure swings, and it will cut through butter like a hot knife, right? Back into discount over here, which we can see that daily discount fair value gap, which was the draw on liquidity after we draw into bearish order flow. So low resistance liquidity up here has been liquidated and we hit that discount fair value gap in discount, right? So how does that look like on an intraday chart for the E-mini S&P 500? We got that 1 hour chart over here, right? So think back about that market maker buy model, that crude depiction we covered earlier. This is the same kind of schematic, only with candlesticks. We've got our draw on liquidity on the highs, right? And then our higher time frame discount array, which in this case is that daily discount fair value gap. Now over here we got that high resistance liquidity run, right, against order flow, right? So it rejects that low immediately and starts to go into bullish order flow. Now notice where are the failure swings, right? We've got all these failure swings up here, which is low resistance liquidity. Now also notice how this is still in discount levels, right? Because the premium is about around here and we want to move up into that draw on liquidity, which is up here, and then target all that low resistance liquidity, all those failure swings up here, and then eventually up here on a draw on liquidity. So over here we've got our Euro USD monthly chart, right? Let's see where our premium and discount levels are. So from this swing high up here into this swing low down here, we've got our whole dealing range. So everything up here is in premium, everything down here is in discount. So what did we hit recently? Did we hit a higher time frame PDRA? We've got this monthly premium fair value gap, right? So that's a perfect area where we can reject from, and on the lower time frame we can scout for an opportunity to get into a sell. So let's go to the daily chart. So over here we got that Euro USD daily chart, and remember we hit that higher time frame bearish array, right? That monthly premium fair value gap. So over here we've got some nice structure, right? What do we want to see when we want to sell? We want to see a high resistance liquidity run, which confirms we are going into bearish order flow, right? So how does that look like? So over here we've got that high resistance liquidity run, right? So it's a swing high that takes out another swing high and then immediately rejects price action. And we can see over here it fails to take out this high once again. So it starts to trade lower and lower and lower. Now we want to target that low resistance liquidity, right? So where is that forming? Over here we've got all these lows, right, which are forming, which is a failure swing. Again over here, failing to take out these lows and these lows. And over here we've got some relative equal lows. So that's a very good to draw on liquidity, and we call that low resistance liquidity. Right now, where does a opportunity lie to go into these lows, right? We're scouting for a premium array once again. So what is available on the chart right now? We've got that volume imbalance up here, right? So that's also a good area to take a sell from, and you can actually see how willing price action is to go through those low resistance liquidity lows, those failure swings, right? So you can see here price action goes down with ease, right? And that's the whole point of that low resistance liquidity.